Good morning, everybody. Hope you're doing well. Hang on just a second. All right. So once again, thank you very much. Hope you're all doing hope you're all doing well. I have looked at some of your work on discussion boards. Some of it is good, and some of it is absolutely awesome. And I'm thrilled at the quality of work that some of you have demonstrated. I mean, look, it's your master's students at a top university. What is important for you is to be able to think through things. So I'm really glad that you're doing so. And as I have mentioned in this course, we will not do any made up data. We'll work with real world, the real facts, real numbers, real facts, real logic, real theory. And I'm really glad that many of you have participated and are doing so. All right, so today we will first have me discussing institutions. So today is the whole topic of today's lecture is financial institutions, of course. First, I will go for about an hour, a little less than an hour, on institutions in general, with a particular focus on US institutions. And then we will have a presentation by two of my former students from the University of Maryland on Asian capital markets from 11 to 11:30. And then we will have a presentation by two more of my former students from the University of Maryland on European capital markets. So hopefully by the end of today, you will have a very broad and deep sense of financial institutions. All right, so without further ado, I'm going to share my screen, and hopefully you're able to see my the PDF document. Let me make sure that you are. Yes, you are. So that's good. All right. So as I mentioned, today we are going to discuss financial institutions. Let me put this on full screen mode. And so first of all, this is capital markets or financial markets in general. This is a very crude division. And for our purposes, that's what we're going to look at. And the semester, our course is also structured along these lines. But financial markets are much more complicated. And as I have mentioned to you, capital really means in economics pretty much everything but labor. So for instance, real estate would be something you would add on to this. But we are kind of keeping it simple for the time being, because that's what we're going to focus on in this particular course. So by far the most interesting and most studied, no, actually I shouldn't say most interesting, it's most studied and comprehensible to us is the idea of equity. And that is simple, the idea of having a share in a particular entity. That's defined as equity. And we will discuss very shortly. Equity, once again, kind of crudely can be thought of in three different buckets. First is the common stock, which is by far the most easy to understand, which is, for instance, if you and I were to start a business and you say, Professor, will you invest in my firm? I can do it in a bunch of different ways. One could be simply by saying, okay, I'll invest and take ownership of 40% of your firm. So that is an example of common stock. And later on, we'll see the distinction between private equity and public equity. That's idea of publicly traded versus private is something that goes on to pretty much every asset class as well. All right, so I'll come back to alternative investments in just a minute. Let me continue on equity. So equity, we have a common stock, that is the standard idea. And then you have preferred stock, I'll discuss in just a minute. And ADRs, which are American Depositary Receipts, where you can have a foreign a company which then sells an equivalent equity or a share or a security in the American markets, which allows this foreign firm to access American capital markets and provides American investors an ability to invest in those foreign firms as well. So I will actually later on in this course spend a bit of time explaining to you, giving you a particular example of a Brazilian firm, which I was involved in a litigation about. So, so I actually have a lot of internal data and so on about this Brazilian firm and its American Depositary Receipts that were traded on the New York Stock Exchange and how we can deal with all of that. All right, so going back to when you have a company and you say, Professor, can you invest in my company? So one of the things, as we mentioned, was for me to invest in your equity and say, all right, I'll buy 40% of your firm. Alternatively, I could say, all right, I'll loan you $100,000 and you pay me, let's say, 5% per annum as a return for as long as the debt matures. So that's an example of fixed income security. All right, and these are essentially the two most standard methods of financing of a firm. And we will not spend a huge amount of time on fixed income securities. There are other specialized courses that you can take in this program, which will give you a much deeper understanding of fixed income securities. And finally, derivatives, which are indeed the most interesting. And I just have published a book on derivatives. And that's where a large portion of my consulting and research is on derivatives. And that's the ideas of, for instance, futures, forwards, options, and all of that stuff, which we will spend a significant portion of time after the midterm on looking at derivatives and applying them to various market situations. All right, so this, as I said, is a very crude breakup of the major asset class. It leaves out things like real estate, which we will not study in detail in this course, but I will talk about a little bit as we go along. Okay, so talking about equity. So what are the types of public or private equity? Equity, let's first talk about equity in principle, and then we will distinguish between public and private. Okay, equity, simply, it's a partial ownership of a profit-making entity. Now, profit-making is not the right word. You can have ownership in an entity that is making losses, but the point is in an entity, in an economic entity. So, so the first thing to keep in mind is this common stock. So you have ownership interest in a company. It does not have any maturity per se. The thing to keep in mind that the common stockholders only have a residual claim on the firm's assets. So most junior last in time in event of bankruptcy. So if a firm is doing well as the part owner of the company, you have full access to the upside of the firm. However, if the firm were to go bankrupt, you are the last in line to get any part of the proceeds of the company's dissolution or reorganization, etc. So for instance, it's first in line, surprise, surprise, are the lawyers. And then you have, and we'll talk later, for instance, debt holders. And then you have preferred equity. And then you have common equity, which is at the very end. Okay, preferred stock. What is preferred stock? Is, in fact, it has, it's a hybrid. It's a mixture of equity and debt and bunch of it has features of everything. It has no maturity, but the point to understand in the context of a preferred stock is that it is senior to common stock in the case of bankruptcy. So as a preferred stock, you have access to the upside maybe not as much as the common stock because you have, there are restrictions, etc. But in the case of bankruptcy, you are ahead in line of getting the proceeds of the reorganization over common stock, but you will still be behind debt holders and lawyers and so on and so forth. Okay, so that's the idea of common stock versus preferred stock. There is this idea of convertible bonds where, we will talk a little bit later about fixed income securities. A bond is just another name for a fixed income security, and that pays interest, but the convertibility is the idea that after a certain point, a bond can be converted into equity, or sometimes it can, sometimes it must. These are all terms that can be incorporated into a security. I mean, the idea to remember is anytime you are dealing with a financial market, in a private investment, in a private financing, you can pretty much set up whatever deals you want, whatever terms you want. So that's the idea of a convertible bond. Exchangeables, once again, that's you own a particular security that grants its holder the right to exchange it for common stock. And that's often used in the case of takeovers. Okay, one thing I wanted to point out too, convertible bonds. For instance, Tesla has convertible bonds, and one of the issues last year was if the price went to a certain point, then it could be converted into equity, or they had other bondholders had rights. So that was something there was a lot of discussion on about these convertible bonds. Okay, so these are all equity. Now, what is the difference between any equity, or for that matter, any securities, public version and a private version? Once again, in a private version of any security, you and I, if we are engaging in a private transaction, we can pretty much put in any terms we want. When to mature, what payments to make, what to happen if we were to disagree, what kind of legal arguments we can make. All of those things can be put together in a private transaction. Similarly, for any security, and so of course, in particular, you can do it for private equity. However, what we will see, and we have already spent quite a lot of time on, when markets are when a particular security is publicly traded. So for instance, we talk about a firm being publicly traded. That's really a short form for the firm's equity being a publicly traded security. What that means is that that particular security is standardized and therefore is available to the market. And in that case, one share of Google is exactly the same as another share of Google, and therefore an investor is perfectly substitutable between those two securities. So that's the idea of a publicly available security. It is traded. The information about its price is available to the market. You can decide whether to invest in it, whether to buy the security or not buy the security, and on it goes. So that's the difference. And later on, when we do futures and forwards, we will also see exactly the same difference. A forward is a private version of futures. Similarly, with the debts, you can have debts that are private arrangements between the borrower and the lender, whereas you can have debt that is publicly traded. For instance, we have in the case of US Treasuries, which we showed last week, we looked at some of the data. Those securities are publicly traded because they are standardized, and we will later on see some of the properties that are essential to this standardization. Okay, market indices. I showed you some data last week on index of a market, and that's the idea of asking the question, how is the market as a whole doing? Now, it is what we are trying to approximate is what is the overall investment portfolio that is available to an investor. Now, so this is a very, very loaded question. What is the universe to keep in mind? In particular, And later on when we do CAPM, we will discuss this, not in a whole lot of detail, but we will get into some of the details that the investments of a firm, of an investor, are not necessarily just equity or fixed income securities or derivatives or even real estate. It could be investment in human capital, right? So for instance, you're doing this course is a significant investment of significant amounts of US dollars in development of your human capital. So, so that's also to be definitely kept in mind going forward. So, once again, market index or overall investment index is a very, very complex phenomenon. So we will therefore say, okay, what possible universes can we talk about? So equity being by far the biggest investment portfolio, there are many different equity indices. And equity trading has been going on for hundreds of years. So therefore, it is much more developed. By far the most well, important is not the right word, most commonly cited and oldest index in the US is the Dow Jones Industrial Average, DJIA, which, loosely speaking, tracks the 30 top firms in the US. And we saw how to get the data. We can look at the data for the Dow Jones Industrial Average. You can get that from the S&P 500, from Yahoo Finance, for instance, and so on. Now, Dow Jones Industrial Average is, it's a really old index. That's something, and we often really use it in order to make it historically comparable. Because otherwise, top 30 firms is really very limited. Why did it have top 30 firms? Because remember, when it first came out in 1926, calculating the overall return for 30 firms was quite complicated. You didn't have access to modern computing. Basically, pen and paper is all you had to do, all you had access to. So that 30 firms is what we focus on. The S&P 500 came into being in the early 1950s when computing had absolutely exploded. Since then it has exploded much more, which is why in 1950s when they took essentially the top 500 firms of the in the publicly traded in the US, that was a huge development. And S&P 500, once again, it loosely speaking tracks the top 500 firms in the US. As I mentioned to you, why restrict ourselves to 500? So when we downloaded data from CRSP, for instance, we saw the value weighted return for the whole market or equally weighted return for the whole market. Why not do that? Well, that's what we do most of our work today. When we're doing brand new work, we tend to look at those returns for market, which you can calculate every day, which on CRSP, for instance, which is reported on CRSP, or as I do for my research and consulting, essentially calculate these value-weighted returns a few times a day, every day. And that's what a lot of market participants do. So that's available now. That is a much more accurate way of looking at it. Now, as we've talked about, and one of you pointed during your discussion boards participation, when you do the value-weighted return, you really put so much, because for instance, Apple, which has a market cap which is 1,000 times the market cap of Navigant. So Apple's return gets 1,000 times more weight in a weighted, value-weighted index. So an S&P 500 index will really be very close to a value-weighted return. So that's something to always keep in mind. So if you, for instance, don't want to weight Apple 1,000 times, then you can use the equally weighted, where Apple's return and Navigant's return get equal weight in the calculation of the index. And depending on what it is you're trying to measure. So so once again, now there are various sub indices. You have the NYSE Composite, which is an index for fixed income securities that are traded on the New York Stock Exchange. And then you have the Wilshire 5000, the NASDAQ Composite. In terms of international markets, you have the FTSE for London, the DAX for Germany, Nikkei for Tokyo, Hang Seng for Hong Kong, the SSE, which is the Shanghai Stock Exchange, and many others. Okay, in Australia we have the All Ords. In India there is Nifty, and so on. So there are many such indices. Now, if you will actually, if you go to Yahoo Finance, as I have showed you, there are some worldwide indices as well, versions of the Dow Jones and the S&P 500 for worldwide indices as well. So there is plenty of information available in order to track these equity indices. So now, similarly, there are also a variety of bond indices. For instance, Bank of America, Merrill Lynch, Barclays, etc. They put together many bond indices. But fixed income securities, because they are not as heavily traded, though their data are not as widely available and are not as reliable. So these indices are, always to be taken with a pinch of salt. And also to keep in mind, later on when I do fixed income securities, I will talk about these indices in particular. Because they are not as heavily traded, a lot of the index data are what are called matrix data. They are actually estimated data. So you are estimating an index based on some actual prices and some estimated prices. So you lose out on the residual factor, which has serious problems when we talk about the econometrics, which we will do later. All right, well, weighting of components, I have done, spent a lot of time on. So you can, price weight it. It's really not that interesting, but that's once again for historical reasons. We still use the Dow Jones Industrial Average. Then you have the market value weighted, which is pretty standard, which is the S&P 500, NASDAQ, and the value weighted return that we have talked about. Or you can have the equally weighted, which is value line, and also the equally weighted market return that is available on CRSP. How do you average these returns? In principle, it is arithmetic average is the standard way. In value line, they actually take a geometric average. Now, one of the things that you must remember from high school mathematics, these methods of calculating the returns are actually quite close for small movements, and returns on a daily basis are pretty small. So they are pretty close to each other. And we will continue with that. All right. So how do firms issue securities, or how are securities in general issued? So there are these, first of all, they don't have to be publicly issued. I'm going right at the bottom first, private placements. So going back to when you decide to ask me to invest, let's say $100,000 in your firm, and you say, please, would you like to buy 40% of a firm? That's a private issuance of security. So that's a private placement. The public, remember, anytime a security is publicly placed, that has to be standardized. And some of the things to keep in mind are, for instance, these IPOs, what are referred to as initial public offerings, or SEO, secondary equity offerings. When we do equities and talk about IPOs, we'll spend a little bit of time on role of underwriters and book running. In the US, for instance, it is standard when for a firm, when it goes public, it will take, it will appoint a group of investment banks to form what they call a syndicate, and they will then go out and do these prospectus and road shows where they will gauge interest among investors for initially investing in this firm. And then on the basis of all this information, they will set a price at which to sell the initial offering. Now remember, this is a price at which you're initially selling it. That's not a market price. So think about this. This is when you, let's say, want to buy tickets for the Washington Wizards basketball game. So you go to their website and buy a ticket. That's, really not based on market rate. You can buy that ticket. However, if you want to resell that ticket, that's when it is market data. All right, so that's something to keep in mind. So you buy at the initial public offering, that's not pure market, well, it's market driven, but not market traded. So that's the initial public offering. It's in the resale, that's what the public markets are all about. Uh, so you know, historically, and you should go to this Professor Jay Ritter's data on University of Florida's website that I have mentioned over there, has really, really good quality data on these initial public offerings. Historically, there was the idea that you would get this initial public offering, and in the first days of trading, you would get this huge pop. That is to say, you would, in your price, you would get a huge return on that first day. Now, that is something we financial economists have always said, well, if you do that, then you're leaving a lot of money on the table. So Google did its IPO as a variant of a Dutch auction. So it went outside and essentially said, okay, if the price is X dollars, how many shares are you willing to buy? If the price is X plus 1, how many shares are you willing to buy? If the price is X plus 2, how many shares are you willing to buy? And then set a price P star at which demand for shares equilibrates with the supply of shares, with the total number of shares that you are placing into the market. Now, in Dutch auctions, typically you can have different investors paying different prices for the same share, but that is not allowed by the Securities and Exchange Commission. So that's why I said it was a variant of a Dutch auction, because all investors in the initial public offering had to pay the same price. Now, one of the things that happened as a result of Google's going IPO was that it did not have a huge first day return. The second day return was actually pretty good, but the first day return, the pop from the IPO price to the close of the first day was not huge. And a lot of unsophisticated commentators said, oh, Google's IPO has failed because it did not have that first day pop. Whereas more sophisticated analysts and commentators were like, no, on the contrary, Google did a good job because it did not leave money on the table. So that's now one thing also to keep in mind, and that's something I wanted to talk to the previous slide, is that Google also has multi-class shares, which and also in 2014, as I showed you in the data last week, Google's has restructured itself with Alphabet being the owning entity of Google. And so it has restructured with the ticker symbols changing and so on. And what also Google has done is different classes of shares where most of the initial owners own the class of shares that have much higher voting rights. So they have, in a sense, separated ownership from control to return. Now, anytime there is this publicly traded equity, there is a separation of ownership from control. Ownership goes to the equity holders, but control remains with the managers, whom principally, in principle, the shareholders do appoint and can replace. And I have actually done quite a lot of work on understanding this principal agent problem, which we're not going to get into because that's kind of more of a corporate finance, corporate management issue. But if you are interested, I'll be happy to send you my papers on that stuff. So going back to this, what Google was able to do is to say, well, we will let you invest in the invest in Google as an investment opportunity, but we will retain control over the direction of the company. So the two classes of shares have different voting rights. So that's, again, a firm can do all of that, and clearly it has done it very successfully, but it is different from other firms. All right, so there was a massive IPO securities litigation last decade involving 307 IPOs. That was a litigation that I personally spent a lot of time on. So what we often find is these IPOs are often oversubscribed and underpriced. Why is that so? And there were various different allegations, one of which was the quid pro quo, which is that I will give it to you at a less than market price. In return, you will give to me at a less than market price when you are in charge of taking another firm public. Laddering is the idea that I will give this particular share to you at a lower than market price. In return, if I were to call you and say, hey, my stock is going down, please buy some shares in order to move the price up. Laddering. That's the idea of ladder. And finally, the idea of returns to inside owners. And now this is the interesting part. Most IPOs tend to take a small portion of the entire firm public. So for instance, let's say 20% of the firm goes public. 80% of it remains with the initial owners. Now, a year later, a year and a half later, they, let's say, have a secondary equity offering where they sell, let's say, 40% more of the firm. All right. So in that case, having that excess returns coming to those inside owners is a reason to have underpriced and oversubscribed initial public offerings. Now, trading securities. So now we're going to talking about publicly traded securities. There are various different markets. The most old style market would be a direct search market when buyers and sellers seek each other out. Clearly, if there's huge information gaps, it's in fact very difficult to do it. So for instance, let's say in real estate market, that would be where you want to buy a home in California, and the Californian seller wants to buy you, you'll have to somehow find each other. Okay. Now, what is more standard is brokered market. That's, let's say you have a real estate broker who then you want to sell your home, you get in touch with the broker who then gets in touch with buyers. There is a specialized information exchange. That's the idea of a brokered market. Dealer market, which now we're getting much more into the US equity markets, is where dealers have inventories of assets from which they can buy and sell. Now, one of the things that a dealer is also doing, and we have talked about this, is if there is a buy order on one side and a sell order on another side, it can just match the two without taking a position in the market. That's called an agency trade, where the dealer does not take a risk in the market. However, the dealer can also engage in what is called proprietary trading, where it sells or buys on its own inventory. That's where it is taking the risk and where it makes significantly more returns. And there are strong restrictions on when proprietary trades have to give precedence to agency trades. Okay, auction market is where traders converge at one place to trade, and that's the stereotype which we have seen many videos of for instance, what is called the pit. For instance, the New York Stock Exchange, people are standing there with their chits and everybody converging at one place to trade. And you can think of various marketplaces around the world where this was happened. Margin is where an investor can invest with borrowing funds. So for instance, that varies a lot from market to market, from security to security, from country to country. So for instance, in the US today, 80% mortgage is standard for US real estate. It went down to almost 0% in the 2002 to 2008 time period. So which meant you could buy a house entirely on borrowed funds. Whereas in other countries, for instance, in China, it is much higher. For instance, it's very difficult to get a mortgage for more than 50% of real estate in China. So, so the idea is the higher you are, the margin requirement, how much of the opposite of the margin is how much you can invest with borrowed funds. The higher you make it possible to invest with borrowed funds, well, it makes the market more available to investors, which is what happened in 2002 to 2008. A lot more people went into the real estate market. However, because you're making it so much available to borrowed funds, the risks of default are much higher, and which is what one would say was significantly responsible for the Great Recession of 2008, 2009. You know, the trading mechanisms, once again, you have dealer markets, which we have talked about. Also, you have electronic communication networks, which are essentially, there is, you can, if you want to trade in a particular security, you just file a request through an electronic communication network, ECN. And then there are these specialist market, which is the New York Stock Exchange model, where a specialist has the fiduciary responsibility to maintain a fair and orderly market. What are the major US exchanges? The two major US exchanges are the New York Stock Exchange and the NASDAQ. So, the New York Stock Exchange has, for instance, incorporated a bunch of these regional stock exchanges, including the Boston Stock Exchange, for instance, and it lists about 2,800 firms. And the interesting thing is that, you know, there is a lot of automatic electronic trading, but there is this specialist idea. You know, for every single stock on the New York Stock Exchange, there is a particular specialist, typically an investment banker, that clears the market for that trade. Now, the interesting thing about the New York Stock Exchange is the payoff to these the specialists, the market makers. One market maker for a one security is the commissions on the trades. That changes to the NASDAQ, where you have multiple market makers for making markets for a particular security. So we can have, you know, as we have seen, like for instance, with Microsoft, there could be 30 investment banks making markets in Microsoft stock for a particular day. And in that case, the payoff to the market maker is the bid-ask spread. And as we have talked about, there are these requirements that a market maker has to provide the best transaction to an investor, for instance, to the National Best Bid and Offer, the NBBO. Now, as we have seen, as we've talked about, there has been this globalization of markets. There have been many mergers and acquisitions, which are practically impossible to keep track of, and it keeps happening. There we have it. And this is just keep going, that this has been going on, and there every few months we see some more acquisitions. I was at a seminar a few months ago where the president of the New York Stock Exchange and her predecessor listed something like 100 acquisitions over the past 15 years. So we know whether all of these acquisitions make sense. Well, only time will tell. But the point is, there has been an incredible amount of globalization in the financial markets. Whether that's good or bad, especially in today's environment, that's a different issue. But the point, this is a statement of fact that there has been a significantly more globalization at this point. Okay. Investment companies. One of the things that I talked about to you earlier is that the emergence over the last 3 odd decades has been this whole category of investment companies and mutual funds. So remember, I was telling you that Berkshire Hathaway has never split its equity. And as a result, each share of Berkshire Hathaway is about $200,000. Whereas, as we saw, various other stocks have had many, many, many splits over the course of its time, because the idea was that you could buy only a whole number of shares. But that has completely changed. This mutual fund is, for instance, you could say, you know what, I don't want to invest in a particular security or in integer numbers of those securities. I want to invest in a whole basket of securities. And these investment companies and these mutual funds provide us with these means to do so. There are various types, and this idea of an open-end mutual fund is where you can buy, you can issue, you can redeem a fund at the net asset value. The closed-end funds, which are, because of the data, are typically much more studied. And an old friend of mine from graduate school, he has become quite an expert on closed-end funds. If you're more interested, I can send you some of his work, where the shares actually trade on markets. Investment banks, mutual funds, obviously they do it with cost. They're going to do this, create these baskets of securities for you, and they do so because they're profit-making entities, and they have their infrastructure costs, their salaries and other compensations to their employees and so on. So there are costs involved, and those are often substantial, which we will see in just a minute. What are the kinds of costs? There is, once again, crudely speaking, there are two kind of buckets of costs. Load, which is upfront, where you're buying a cost, you have to pay a certain amount, typically a percentage, sometimes zero upfront. And then there are these 12B1, which are these costs that they charge for their marketing, advertising, broker fees, operating expenses. There are restrictions on what they can charge, and which we will show in just a minute. So there are these costs, and the costs have to be taken into very, very strict account in deciding what kind of investment to go for. Also, to keep in mind is the phenomenal distinction between the objectives of various mutual funds. So by far the biggest thing to keep in mind is the difference between actively traded funds and passive trade funds. So for instance, most of the Fidelity trading mutual funds are active, where the managers are actively seeking out firms that are doing well, that are higher return, and so on. Whereas the passive approach is where you imitate a particular market and stick with that. So Bogle, the founder of Vanguard, he has a huge, died recently. He has a huge fan following. They're called the Bogleheads. And Vanguard, for instance, I'm not sure if I would call myself a Boglehead, but I am based on my research and consulting, I've come to the conclusion that passive investing is what works best for my family and me. So almost all our funds is in passive funds. In a large part of it is in Vanguard, which was the pioneer of this passive investing approach. You can have equity versus money market. You can invest in equity or money market, or a combination of those. US versus foreign. Once again, a combination of those. Growth versus income. So for instance, if you are in your mid-20s and you have 50 more years or more years before your retirement, you can't afford to take more risks and invest in firms with higher returns, but also higher risk. Whereas when you are at my age, where I only have 15 more years of work, in that case, it makes more sense for me to invest in lower returns or just income firms that pay dividends, for instance, and or have more predictable returns, even though they might be low. That's the risk-return trade-off, which we will spend a lot of time next week talking about. All right. Now, thing to keep in mind is these mutual funds have a fiduciary duty to investors. So one of my first cases in litigation, well, not first case, it was actually kind of middle of my career, was Fidelity. As you know, it's a huge family of funds. So the board of directors of Fidelity, which represents the investors, appointed us to investigate whether the Fidelity broker-dealer part of Fidelity was providing best execution, was providing the best returns possible to its investor. So we actually ended up doing very, very big data work, tick by take, trades by quotes, the kind of things that you have looked at, looking at actually Equity Trade Journal, ETJ data, which is a kind of a souped up version of TAC that you have looked at, to investigate if indeed the broker dealers of Fidelity were giving the best execution possible to shareholders. What has really exploded over the last few decades is this exchange traded funds. So, in addition to your buying funds, the funds can actually trade on exchanges. And for instance, BlackRock has been a huge uh, developer, innovator, and also a major market player in ETFs. One of this person who talks a lot, a former academic, Anand Madhavan, he talks a lot about these exchange traded funds. If you're interested in some of his work, I can definitely send some of it your way. Another thing that I was mentioning to you, real estate is a major investment. And what was possible 10 years ago, or sorry, maybe 20 years ago, is the only way to invest in real estate was for you to buy an apartment or an apartment building or a house and rent it out. Or commercial real estate, you buy a building or buy a floor of a building and then rent it out. Whereas that has been, like this huge democratization that has taken place, you can actually invest in essentially a share of a particular bunch of portfolios of real estate holdings. Okay, so there's real estate investment trust could be one share of a real estate investment trust could be 1/1,000,000th of one apartment in Arlington, Virginia, 1/100th of a commercial office building in Palo Alto, California, and so on. Okay, so you have the ability to combine. So this is this idea of these mutual funds and investment companies. They have provided investors with a much more diverse opportunity. And going back to what I mentioned earlier, it's a democratization of markets. This is a bit of an older data point, but it's still very helpful for us to understand. So to get a sense of what US mutual funds are. So equity funds are still, this is 2009. Things have changed reasonably since then. But as you can see, please go through it in detail. Equity funds, total equity funds, in 2009, the assets were 3,705 billion US dollars, so 3 trillion US dollars. That constituted 38.6% of total funds with 4,830 funds. Whereas fixed income securities funds was about 1.5 trillion US dollars with a percentage of 16.3%, and a number of funds being 1,916. The hybrid funds, about $500 billion with 5.2% of assets. Money market funds, that's the, you can actually see it's actually quite substantial, parallels, it's comparable to equity funds. And that is substantially because they are much less risky than equity or fixed income security. So there is a significant market for it, especially among older investors, less risk averse, more risk averse investors. And it is the total, the dollar assets under management is significant. It's very close to the total equity investments. All right. So as you can see, the assets, US mutual fund total is just about $10 trillion in 2009. I will try to get the data for you, which is more recent. Apologize for this somewhat older data. All right. Now, as I mentioned, there are these fees to always keep in mind. So there are, it really matters quite a lot depending on what kind of shares. So this just gives you just within different classes of the Dreyfus High Yield Fund in 2016. So you have this Class A funds, which have 0 to 4.5% front end load, 0 back end load, 0.25% 12B1 fees, and so on. Okay, so Class C funds, that changes. Class I funds, there are changes. And there are these fees to keep in mind. So anytime you're deciding how to invest your money in for your 401k, please make sure you understand. For instance, let's look at this idea. So let's say Fund A, Fund B, and Fund C. Now look at point number 4 at the bottom. So consider these 3 funds which have exactly the same return of 12% per year before expenses. Now, just see how different the total returns are depending on how the costs are. So Fund A is no load with a 0.5% expense ratio. Fund B is no load with 1.5% expense ratio. Fund C is a completely different animal. It has an 8% load on purchases with a 1% expense ratio. So you can look at it right at the top. Fund C, you put in $10,000. So all of these are initial investments of $10,000. But for Fund C, because there's an 8% load, $800 is taken off right from the top. Okay, so please be aware that these things take off a huge amount. So if you do these calculations, you can see Fund A after 20 years is worth the $10,000 that was invested in each of these. Fund A after 20 years is $88,000. Fund B is $73,000. Fund C is $74,000. The same returns, but significantly different amounts, the net going back to the investors. All right. So, and that has been what we is often referred to, and what Bogleheads will often talk about, is referred to as the power of compounding. One of the things to keep in mind is passively investment funds typically have much lower fees and expenses, and so this subtraction that goes off in the compounding, which can be quite significant, is much lower. However, the number 4 is this idea, the footnote number 4, where gross return is 12%. What actively managed funds will argue is that their gross returns are higher because they are actually using specialized, competent, experienced managers to decide which securities to invest in. So the gross returns are actually higher for managed funds. As I was mentioning to you, ETFs have absolutely exploded over the past few years. Just look at how it has gone from 1988 to 2015 and has exploded even further. If you can look at the bottom, the 2015 number, you can see the US equity is still broad index is still the highest number. And then you have sector-wise exchange traded funds. Then you have some global international equities. There are commodities, which we will talk about. That is an asset class that we will talk about, not in a whole lot of detail later. And there are these bond or fixed income securities also. If you want more information, please go to BlackRock. They really have done a lot of work on ensuring a properly functioning market in these exchange traded funds. Where do you get information on mutual funds in general and each mutual fund? The first thing to do is to look at a fund's prospectus. Now, a fund's prospectus is, it provides investment objectives. It is required to provide the names and details of the investment advisor and portfolio manager and fees and costs. Everything else is protected by what we refer to as the safe harbor rule. In particular, one of the things that they will say is past performance is not necessarily an indication of future performance. And any projections are necessarily based on the firm manager's individual information, asymmetric information, which we have talked about, and also potentially wishful thinking, optimism, and so on. As we often describe, nobody starts a business intending it to fail. So it doesn't mean they're dishonest. It just means they're more optimistic. So all of that has to be taken into account in deciding how to invest your money. Also, the fund's annual report, which has to provide data on how that particular fund and its family of funds have done over the recent past. In addition to talk about funds in general or a family of funds, the whole universe of fund, Morningstar is a very good source of information. As we have seen, we have gone through Yahoo Finance in detail. Yahoo also keeps track of mutual funds, not as much granular detail as Morningstar. Investment Company Institute is an industry association for investment companies, mutual funds in general, and that's a very good source of information for that as well. And finally, there is this directory of mutual funds, which tends to be exhaustive, but as is often the case for details versus broadness, the directory of mutual funds is not as rich in information, but is exhaustive in terms of mutual funds. All right, let's pause now. It's about 4 minutes to 11. Let's regroup at 11 o'clock. All right, so welcome back. So it gives me enormous pleasure to introduce to you two of my best students of all time, Wenli Zhao and Khushbu Khandelwal, who were both students of mine at the University of Maryland. Absolute superstars. Khushbu just came back to us after spending 6 months at that horrible firm called Goldman Sachs. You know, I, as a person in finance, I think it's absolutely wonderful that Khushbu did that. More power to her. Wenli has, in addition to being a superstar student, has actually served as my teaching assistant, where she was a teaching assistant to the two Italian students who are going to talk, two Italian former students who are going to talk later as well. Wenli is going to start at the University of Pennsylvania for a master's program in quantitative finance, correct?
Yeah, absolutely. Right.
Excellent. So without further ado, on to Wenli and Khushbu.
Thank you so much, Professor. Thank you so much for inviting Khushbu and I. So I would first like to give a brief introduction to the Chinese financial market, and Khushbu will be introducing the Indian financial market. So
okay, I'll quickly point out to you, because this is an asynchronous presentation, so there will be no interaction from the students.
Exactly, yeah, I feel it. Yeah, so let me introduce myself briefly. So I used to study finance with Professor Bhattacharya at the University of Maryland, and I also passed the CFA Level 2 exams and participated in the CFA Research Challenge. So last summer I interned at China Securities. So if you have any questions regarding the CFA exams or internships, please feel free to contact me after this. So to begin with, I would like to show you a picture of some of the largest stock exchanges in South Asia and its market capitalizations. Starting from the top right corner, we have the Tokyo Stock Exchange with a market cap of $5.7 trillion. And the market index is called Nikkei. The second largest one is the Shanghai Stock Exchange with a market cap of $5 trillion. Moving to the middle of the picture, we have the Hong Kong Stock Exchange with a market cap of nearly $4 trillion. I guess many of you are already familiar with the market index of Hong Kong Stock Exchange, which is called the Hang Seng Index. The fourth largest market in South Asia is the Shenzhen Stock Exchange with a market cap of 3.4 trillion, followed by the National Stock Exchange of India with a market cap of 2.3 trillion. We then have the Korea Stock Exchange, the Singapore Exchange, and the Stock Exchange of Thailand with market caps of 1.2 trillion, 700 billion, and 540 billion. So this is a chart describing the returns of different indexes in the past 10 years. The black line represents the S&P 500 with a return of more than 150%. The orange one represents the Nifty 50, and the blue line represents the Nikkei index. Both have returns of nearly 100%. Then comes the green line, representing the Stock Exchange of Thailand with a 10-year return of 75%. We can also observe that almost every market is affected by the outbreak of COVID-19, but most of them are recovering. So after knowing the general development of Asian capital markets, I would like to talk a little bit more about the Chinese financial market. My presentation will focus on the equity market in China, including some different market tiers, along with a stress on the stock market. I'm also going to talk about some main exchanges and indexes. Equity market, also known as stock market, is market in which shares are issued and traded either through exchanges or over-the-counter markets. Such market gives companies access to capital and gives investors a slice of ownership. As we can see in the diagram on the right-hand side, there are two kinds of markets under the regulation of China's Securities Regulatory Commission. One is the formal market, like the stock exchanges. The other is the OTC market. SSE and SCSE are Shanghai Stock Exchange and Shenzhen Stock Exchange. For Shanghai Stock Exchange, it has the main board and the star board. And for Shenzhen Stock Exchange, it has main board, SME board, and Chinext. The biggest system for over-the-counter trading is called NEEQ, which means National Equities Exchange and Quotations. Generally speaking, there's no big differences between the stratified system in China and that of America. More specifically, there are actually four different tiers of the stock market in China, just like NASDAQ, including the main board market, SME, Chinext, and the OTC market. For the main board market, it is established in 1990, and it is mainly for well-established companies, and thus have the highest listing requirements. This market mainly consists of state-owned companies, so it is appropriate for all investors and has low risks. In 2004, to encourage the development of small and medium-sized enterprise, the China Securities Regulatory Commission established another tier as small and mid-sized companies. It has some lower requirements than the main board and thus have a higher risk, but it is also good for all investors. Then comes the Chinext. The idea of Chinext is actually proposed in 1990 before the SME board. However, people's initial was to establish a market for high-tech firms and internet firms. But as the dot-com bubble burst, people lost their confidence in internet and technology stocks. So it was not until 2009 that Chinext has been established. The last one is the OTC market, which includes many stock exchange markets owned by local government. Those are even smaller and has the lowest listing requirements. Due to the high risk and low liquidity, such market is only good for institutional investors or professionals. Besides the floor market, as I just mentioned, there is also another market in China, the star market. It is also called the Science and Technology Innovation Board, and it is established on July last year. It has higher listing standards than the OTC market, but it also lacks lack of regulations. On July 2019, 25 companies went public on this board, and they gained 140% on average by the first day. The performance of the star market in the very beginning is crazy. For instance, shares in NG Microelectronics Technology skyrocketed as much as 520%, and this company makes materials for semiconductors. The performance is partly because that unlike the main board, which has a price limit of 10%, the star market has no price limit for the first 5 trading days and the 20% limit afterwards. So I would like to mention a special feature of the star market. Unlike Shanghai and Shenzhen exchanges, stocks debuting on the star market are no longer restricted by 23 times rule. And I'll talk about the 23 times rule later. By far, the star board has 110 companies, and this is the geographical distribution of those companies. And as we can observe, it is very clear that almost all of them are distributed in highly developed and coastal region. So this is a geographical distribution of companies listed in the main board market of Shanghai Stock Exchange. Compared with the previous slide, which is the star market, these companies are distributed more evenly, like all over China. In terms of industry, as we can see in this picture, for the 110 companies, most of them belongs to new generation IT industry, and a lot of them are actually manufacturers for high technology and telecommunication equipment. The 23 times rule refers to the fact that the initial public offerings are often valued at no more than 23 times earnings and always pop up 44% on their first day in China. As we can see from the picture on the right-hand side, many dots representing.
Okay, I'm going to quickly pause for a second and point out to the students of this particular course that what Wenli is referring to is the price equity ratio, which we will discuss in quite a lot of detail toward the end of the course, which is an indication of how the market perceives the growth of the. And the 44% that Wenli just mentioned is what I was talking about earlier today about the difference, about the pop from the price at which a firm has its IPO to its first day's return. All right, go on.
Exactly. Yeah, thank you, Professor, for the explanation. So if we look at the chart on the right-hand side, we can see like many dots representing different companies are all kept in this line, the 23 times PE ratio line. Therefore, a lot of companies are undervalued severely in their initial public offerings. This makes the trade predictable, and IPOs are often thousands of times oversubscribed, regardless of what the company actually does. However, for the stock market, which is the chart on the left-hand side, new listings won't be subject to the valuation restriction, and pricing will be instead determined by the market. As we can see in the picture, the PE of new listings are almost all higher than the industry average PE. That is to say, instead of being undervalued, companies in the stock market are often overvalued in their IPOs. The result is also predictable. When the valuation is higher than it should be, investors will start to withdraw their money. As we can see from the picture, the market capital of the stock board shrank right after its peak. In mid-October last year, the market cap went back to its beginning value. So it is hard to say if the 23 times rule is really bad or good for the market. It indeed affected the accuracy of the valuation, but without it, overvaluation can be another problem. As shown in the previous slide, the stock market sort of lost its momentum in late last year. However, many companies are still seeing this as a great opportunity. And since tech stocks are less affected by the COVID-19, the stock market are still growing rapidly in 2020. From February to April, more than 3,000 million capitals are injected into the stock market. And this number is amazing, especially when it is compared with Hong Kong Stock Exchange and the main board of Shanghai Stock Exchange. Now I want to talk a little bit more about the exchanges in China. There are 3 main exchanges in China, and they're located in Shanghai, Shenzhen, and Hong Kong, respectively. So let's talk about the Shanghai Stock Exchange first. The origin of Shanghai Stock Exchange is Shanghai Brokers Association, and it is the first stock exchange in China and by far the 4th largest stock market in the world. The Agricultural Bank of China completed their initial public offering in 2010 at Shanghai Stock Exchange, and that is by far the world's 2nd largest IPO. This market contains A shares and B shares, which I'll illustrate later. The index of this market is called SSE Composite, and it is a market value weighted index. The difference between Shanghai Stock Exchange and Shenzhen Stock Exchange is that Shenzhen Stock Exchange is targeting on smaller and tech firms, and the index of the stock exchange is SCSE Composite, which is also market value weighted. Here's a brief demonstration of different industries covered in those 2 markets. We can easily observe that Shanghai Stock Exchange has many financial company listing, and while Shenzhen Stock Exchange is more diversified. The last one, but never the least, is the Hong Kong Stock Exchange. It is established on 1891 and developed its famous derivatives market. By far, it is the world's 5th largest stock market by market cap, and the Hong Kong Exchange has 3 subsidiaries. They are Stock Exchange, Future Exchange, and the Hong Kong Securities Clearing Company. The index of Hong Kong Exchange is Hang Seng Index, and one important trait of Hong Kong Exchange is that it gives Chinese citizens and institutions access to foreign stocks and gives foreign investors opportunity to invest in China. Below is a brief introduction of the A and B share structure in China. A shares are denominated in RMB and are open to domestic investors only. And B shares were denominated in foreign currencies and open to foreign investments only. However, this has changed since B shares were limited to foreign investment until 2001, when the China Securities Regulatory Commission began permitting the exchange of B shares via the secondary market to domestic citizens. So this is quite different from the A shares and B share structure in the US, which represents different voting rights.
Right, which we discussed earlier today in the context of Google. Yeah.
Exactly, thank you. So at the end of the presentation, I would like to use two graphs to present the development of Chinese market. First, we can see that China has a relatively good performance after the 2008 crisis. Second, we may notice that there was a bear market in 2011, and the market correction in the mid and 2018. Third, the AB share structure stays stable over the period.
Okay, if I can just interrupt for a second. So, many of our students, Wenli, are not familiar with financial terms such as bear markets and bull markets. Could you give them a 30-second version, please?
Absolutely, yeah. So if we look at here, if you look at 2011, there's a sort of like decreased trend of the market, and then the market pop up and perform very well until 2018. There's also another trend in like another trend in the market capitalization or a decrease of trading, and people are withdrawing their money, and that is sort of called the bear market.
Thank you.
Thank you. You're welcome. So the if you look at the chart over here, the A and B share structure stays stable over the period, but there's a growing A share listing on SNC after 2013, reflecting the booming number of companies listed on OTC market, which has lower listing requirements. All right, so this is the end of my presentation, and please feel free to email me if you have any questions. Now let's welcome Khushbu to give us a taste about the Indian financial market.
Thank you, Wenli. Yeah, next slide. So here is a little introduction about myself. I am currently pursuing Masters in Quantitative Finance from the University of Maryland. I have had my bachelor's and MBA degree from the University of Mumbai. Last year, I interned with the Goldman Sachs in its Global Investment Research Division. It was a 6-month-long internship, and it was Asia-Pacific position, and I was based out of Mumbai. Prior to coming to the US, I was working with CAFRAL, that is the research arm of the Reserve Bank of India. And I have also participated in the CFA Research Challenge with Wenli. I'm going to first talk about the structure of the capital market in India, and then talk about some recent trends to give you, overall sense of the current macro environment. So here is the broad structure of financial markets in India. Capital market and money market are the two main components of it. These are the platforms where governments and corporations raise money from stakeholders. So capital market is the market where instruments like bonds and equities are traded. So it is a market which deals in long-term loans. Going down further, we all know the primary market is concerned with the new issues or IPOs where securities are sold for the first time to collect long-term capital. The secondary market, on the other hand, is where buying and selling of already issued securities happens through the medium of exchange. The main feature of the secondary market is basically it creates liquidity in the system. And we also have derivatives as part of the capital markets. So the capital market acts as a strong link between savers and investors of the economy and helps in capital formation and economic development of a country. On the other hand, we have money market, which deals with short-term financial needs of the economy, and where financial instruments such as treasury bills, call, notice, term, repurchase agreements, CP, CDs are traded. So these are the instruments with high liquidity and very short maturities. ranging from overnight up to 1 year. Capital markets are regulated by SEBI, that is previous slide, Securities and Exchange Board of India, while the money markets are regulated by the Reserve Bank of India. Next. Nifty 50 is the main index of National Stock Exchange. It is a well diversified 50 companies index representing 14 sectors of the Indian economy that are listed in the table below. The index was set up in 1995 with a base value of 1,000 and is now trading at 9,900 with market capitalization of $1.5 trillion. So the index is basically computed using free float market capitalization method and can be used for variety of purposes like benchmarking. Next. So Nifty 50 index last year touched an all-time high levels, generating 12% return for the year 2019. However, it has reversed all the gains in this year, as you can see. Last year, if we zoom into the chart, we will see the second chart. Last year, it rose until May 2019 due to a decisive electoral mandate for the NDA in general elections and an accommodative stance of the monetary policy by the Reserve Bank of India. But then, all gains were erased due to some unfavorable tax proposals announced in the budget, rising geopolitical uncertainty, trade war concerns, etc. But then the rally resumed in mid-September following the announcement of a significant corporate tax rate cut and some other measures that were announced by the government to basically revive the economy. However, it again slumped sharply post COVID-19 outbreak, as we can see, but slowly recovering now. Next. As I mentioned, there were the number of companies that got listed on NSE in 1995 was 135, and it has now risen to 1,942 companies.
Okay, Khushbu, quickly, what exactly is the fundamental difference between the NSE and the BSE?
These are the two major stock exchanges in India. BSE was formed even earlier, and then NSE came later.
Okay, is there like in the US, we see more tech companies going to NASDAQ, and as Wenli said, there are similar patterns in Chinese stock markets. Is there a similar broad differentiation between firms listed on the NSE versus firms listed on the BSE?
No, there is no like sectoral difference, but then
how about size?
50 is the primary index for NSE. However, Sensex is the primary index for BSE. So Nifty 50 is basically, composition of 50 companies. Sensex is composition of 30 companies. So like these minor differences, but not, like sector wise.
Okay, thank you.
So the number of listed companies on BSE is 5,461. Along the secondary market, the market for IPOs has also witnessed rapid expansion. And in FY19, total funds raised through IPOs stood at $2.85 billion. Next.
So it actually went down from 2018 to 2019.
You're talking about? I'm talking FY19. Yes, it went down.
Okay. All right.
FY18, it was $4.43 billion, but then it went down to $2.85 billion in FY19.
Thank you.
Yeah. Yeah, so there is continued growth in equities and derivatives segment. As I mentioned that, the number of company listing has been consistently rising, which widens the playing field for brokerage firms. If you look at the second chart, the derivative segment is also growing rapidly, which the turnover for derivative segment for FY20 stood at $49.4 trillion, and for FY21, which is like just so in India we have financial year from starting from April to March. So this FY21 figure is just for 1 month, April 2020, and it stood at $4.06 trillion. Private equity and venture capital investments also grew at 44% over the past 3 years, and they've reached at the value of $48 billion in 2019. Next. Talking about the mutual fund industry, they recorded asset under management CAGR of 12.6% over FY16 to 20. India is considered one of the preferred investment destinations globally. So AUM of the mutual fund industry stood at $339.5 billion.
Just once again, Wenli and Khushbu, because many of our finance students are not that familiar with finance terms. So could you just tell them what CAGR stands for, please?
It's a cumulative annual growth rate. Yeah. Okay. So it's the cumulative growth rate, basically.
Well, it's compounded. That's the annualized rate.
C stands for compound.
And the point is it's annualized. So
yeah,
that is to be interpreted as 12.6% per year, not over many years.
Yeah.
Well, measured over many years, but annualized. Yeah.
Yeah, thank you. Thank you. Yes. So if we look at the investors, who are the investors in these mutual funds, so we see that corporates are by far are the largest investor. If you look at the pie chart, with the $136.59 billion of AUM, and followed by high net worth individuals and then retail investors. Next. So this is the analysis of ownership trends and patterns in Indian companies for the quarter ending March 2020. So March quarter saw a huge jump in private promoter ownership because of sharp market sell-off, which provided an opportunity for promoters to raise their stakes. So we see that private promoter ownership is 44.4%. Then government ownership in the NSE listed space has been coming off since 2010, which is because of government's efforts to garner higher revenues through the divestments. So the share has now fallen to 6.9%. FII ownership fell by a huge amount. It is now at 20.8% and fell, reflecting the record high foreign capital outflows, which were like $7 billion in the March quarter, and it was due to flight of capital to safe havens because of concerns of global recession.
Okay.
So if you look at the second chart, we can see that FIIs maintained their largest bet on financial sector, and they turned really cautious on consumer staples. So this is the breakup of their share.
Okay.
Next. So looking at the macro picture, The sovereign yield curve has really steepened over last couple of months with the drop in yields. But the drop was seen up to for up to 3-year maturity, and it was because of a steep 115 basis points cut in repo rate. Repo rate is the benchmark lending rate in India.
Okay, if I can interrupt you for just a second. We will discuss the treasury rates and in sovereign yield curves, etc., in the context of fixed income securities in a few weeks. Okay, go on, Manali. Sorry, Khushbu, go on.
Yeah, so if you look at the second chart, it shows that the spread between the long term and short term rate has really widened up to 3 years. But for the longer term, this yields remain high, and it is probably because the fiscal deficit is going to be really high this year. So there will be a huge supply of government bonds, and that is what has kept the yields really high for the longer term. Next slide. Yeah, so corporate bonds spreads shot up. It shot up in March and April because of tight liquidity conditions. Because there were huge FPI outflows, and there was a really sharp drop in the trading activity. But then there were a lot of measures taken by the Reserve Bank of India over last 1 month, which helped ease the liquidity in the system. So we see that the spread has started coming down. Yeah, next slide. So yeah, after being one of the fastest growing economies in the recent years, the Indian economy has been witnessing a severe slowdown since last year, and both cyclical and structural components are responsible for it. So the fourth quarter GDP fell to 11-year low of 3.1%. Yeah, and so the entire FY20 came out to be at 4.2%. The slowdown was it has been broad based, with both private consumption and investments remaining extremely weak. The other conditions that were already there in the last year, like muted demand environment, weak business confidence, and low capacity utilization, tight financial conditions. These things were already there in the last year, but they got even worse with the COVID-19 outbreak. So the second chart shows the FY21 budgeted fiscal deficit as 3.5%. However, we with the COVID situation and with the lockdown in India getting extended to almost 2 months now, the fiscal deficit is going to be much higher than this. Next. So this is the first chart shows the volatility that it's declined. It has declined gradually, especially after there was a SEBI restriction on short selling to basically curb excessive speculation. But if we look at other countries in the chart, we see that other countries have also followed the similar trend. So we really don't know if it was particularly because of SEBI's restriction on short selling. Looking at the second chart, if you just look at the green line, which is for FY20, so the positive trend continued over the first quarter of FY20. With positive outlook of Indian economic growth, but then it came down a bit during May because of uncertainty in general elections, but then again recovered after getting a clear mandate for the then ruling party. But then the trend has completely changed since February, since the time that COVID-19 outbreak has become the pandemic. So this has added concerns over this, like, for a severe global recession, and there is increasing probability of default by many large companies, particularly in the sectors such as aviation, tourism, and other non-essential commodities. Next. Here is this is my concluding slide, and I show a comparison of major exchanges globally. So NSE is at the bottom. NSE's market cap declined by 31% YOY and has now come down to $1.5 trillion in March. It lost 2 positions to end up as 14th globally based on domestic market capitalization, and it's all because of coronavirus pandemic. BSE we see is at 13th position, while the top position is maintained by New York Stock Exchange, followed by Nasdaq and Japan Stock Exchange. This was from my end.
All right. So, as I have mentioned to you all over in class as well, Goldman Sachs is the platinum standard. Well, gold, platinum. Well, we'll use metals interchangeably. So Wenli's graduate program in the University of Pennsylvania is also once again a platinum standard as far as graduate programs is concerned. So I will take the liberty of volunteering Khushbu and Wenli to answer any questions that you might have. These are great people to have as role models for you going forward. So without further ado, thank you very much, Wenli and Khushbu.
Thank you.
You're very welcome, Professor. Thank you so much.
All right, excellent. So now to have the Italian contingent, Jacopo, how did your interview with the London Stock Exchange go?
Okay, it was okay. It was okay. I had to interface with the responsible of finance. So market supervision, signaling to CONSOB market abuses, and the responsible for technology. So IT software developer for IT infrastructure for capital markets. And it was okay. The feedback will be provided next week, but hopefully we will get in.
Excellent. So I keep my fingers firmly crossed for you.
Thank you very much, Rajiv.
As we say in America, break a leg. Don't break a leg. All right, sorry, I can't resist bad jokes. And Marco, I can't see your face, but which is okay. There you are. Okay, good. All right, so now Marco and Jacopo were both students of mine in an advanced derivatives course at the University of Maryland. Both of them did fabulously well. They're both doing master's course programs at the University of Bocconi in Italy. And it's an absolute pleasure to have them both back. And so without further ado, Marco and Jacopo.
Okay, so we move from Asia to Europe. Let me share my screen and my presentation. Okay, so now you should see, and we have our presentation on European capital markets. Let me put full screen for you. Okay. Now, these are our emails. So as Rajiv said, please don't hesitate to ask questions, but now we start. This is our agenda for today. So I will perform an introduction on European Union and on equity markets, and I will leave the stage to my colleague Marco for bond markets and derivatives market. So the first thing to say is to define the European Union, which is different from the European continent. So the European Union was born in 1992 with a political and economic supranational union of 27 countries. Among those 27, which were added during years, so the initial countries were only 12, but today, out of 27, 19 countries share the same currency, the euro. The European Union plays a strategical role in the international geopolitical scenario, as without the European Union, the world leadership would be contended by US and China. And as we know, there are many concerning actions between those two nations in the recent years. And one point worth mentioning is that in 2020, in January, so before the COVID crisis, European Union lost the UK after the Brexit, and this impacted a lot on capital markets. So the first thing is to make this presentation very clear to you, is to compare what you should know better than me, so the US capital markets and the US system, and the European Union system. So the main difference is the division of competencies and powers, because US is a federal nation, and the Article 1 of your constitution should define, from what I know, the competencies of the Congress and what is left for the federal states as residual powers. While the European Union was born as a system of individual member states, which were once individual, and each of these countries agreed to sign international treaties to transfer sovereign powers from states to the EU governing bodies, which are the Governing Council, the Parliament, and so on. So this is the main concern, because European member states were independent nations, and so they all had market exchange, their own market exchange, and their own legislation on markets. By years, so with the growing power of European Union as a governing body, both European authorities and governments are trying to harmonize this multi-exchange system in a unique, comprehensive exchange, but this is very difficult because we still have some traces of nationalism in Europe. So just to make other comparison, we can see that the European Union has a comparable dimension with respect to United States and China in terms of inhabitants, in terms of nominal GDP, and in terms of general dimensions. One thing worth noting is that in Europe we have negative risk-free rates on our bond yield, which is not something usual we can see in every market. But after the COVID, from what I read on the press, we know that United States are looking forward to something reducing their interest rate on the risk-free rate. We don't know if they will yield negative, but there are still some concerns about that. Going on, we present our equity markets. So these are the three main stock exchanges in Europe. The Euronext was resulted from the merger of Amsterdam, Paris, and Brussels stock exchanges in 2000. It is the largest stock exchange in Europe and has a market cap of 4.7 trillion and lists more than 1,200 companies. I wanted to mention London Stock Exchange, even if now we've had Brexit, but you know, I'm Italian, and London Stock Exchange Group merged with Borsa Italiana, so I should mention that London Stock Exchange is headquartered in London and is the second largest exchange market in Europe, with 4.2 trillion of market capitalization and more than 2,400 companies listed. Is one of the most ancient stock exchanges in the world. The third one is the Deutsche Börse. We can see that Deutsche Börse is the competitor of Euronext and London Stock Exchange Group, and it failed to merge with the New York Stock Exchange in 2008 and failed to merge with the London Stock Exchange Group. The Deutsche Börse is headquartered in Frankfurt and has around 2 trillion of market cap and more than 500 listed companies. Now, to understand the magnitude and the dimension of equity markets, we can clearly see from this graph that US really overwhelms other countries in terms of equity market capitalization. And we can notice that apart from Japan, US, China, Europe, and UK has a decreasing trend in the last year. These are all data coming from the European Capital Markets Institute, and they are updated up to 2018. And we can see that the trends are similar. So there is an increasing trend in the 90s, some fluctuation in the first decade of 2000, and we have an incredible increasing trend starting from 2010, especially for US. Now, to make another comparison to understand better, we can say that the comparison between equity market cap and gross domestic product, the ratio of the two are very positive for US and Japan, which show values far above the 100%, so respectively 160 and 150. And China, which has a ratio of nearly 100%, but a really, really growing trend. And
so, okay, CH is Switzerland, not China. The one at the extreme left?
Yes, no. I was mentioning China, which has 100%. There is the red.
Yeah. So your abbreviation for China is CN, but the abbreviation for Switzerland is CH. I think it's Confederation Helvetica or something. That's what even their internet abbreviation is CH, which actually can be quite confusing because your first instinct when you see CH is to think China. All right.
Okay,
so,
now I get what you're saying. I wasn't realizing because I know I look at the flags, so
right.
I didn't see. Okay, and so we can see that European Union has a much less developed equity capital markets with respect to other nations which are put in comparison. Now, these are the main indices that are present in Europe. So, for example, the FTSE MIB is the Italian one, the IBEX is the Spanish, CAC 40 is the French one, the FTSE 100 is the English one. You can see the list here, and all these indices include the more liquid and the higher capitalization, the highest capitalized companies in each country. And as you can see, Eurostoxx and Euronext are multi-country indices because, as I said, they are they result from mergers. Now, just to make the graph understandable, I'm comparing in this graph the top European companies in terms of market capitalization with Amazon. As you can see, the comparison is something weird because Amazon, before the COVID-19, so the data is updated up to January, just not to distort, because Amazon is much overvalued after the COVID. Other companies like Louis Vuitton, which is the first European company, is so undervalued after the crisis. And so we can see that the first 5 European companies just sum up to Amazon market capitalization. So you can understand the dimension of equity capital markets in Europe is far less smaller than the American one. Now, going on, we added from the last time, and Rajiv will be so happy for this because he loves those graphs, I think.
Yes, indeed.
And this is a comparison between the the prices. So of the Euro Stoxx 600, which is the most significant index in Europe in terms of dimension, because it lists 600 European companies, and the Standard & Poor's 500. And we can see that the COVID affected both, as we can imagine. And the impact was very severe between March and April, and the worst return in both indices are around minus 12%, which is, as you can imagine, a very negative daily return. However, we have to notice that the American market is kind of recovering more rapidly, and this is due probably to the more flexibility of American companies, American legislation with respect to European one, and also the greater return over the period. We are dealing with daily returns is around 8-9% for both indices. Now we're looking at the COVID effect on volatility. So this is also a comparison between the VIX and the VSTOXX, which are both American and European volatility indices. And we can see that even in this case, they're both affected by COVID virus pandemic, and the volatility surges in March and peaks at almost 90 for both. We can notice that the volatility is much similar, is much more similar than the index prices. And as we can see, by May and June, we have a stabilization, a kind of stabilization over a higher period of volatility. So your options will be valued more. Now I will leave the stage to my colleague Marco, and just 1 second that he's sharing its own screen.
Okay, thank you, Jacopo. Can you all hear me well?
Yes.
Yes.
Okay, here we go. So, thank you, Jacopo. I will talk a little bit about the bond market and the derivatives market. First of all, I want just to clarify that the bond market is a very important market in Europe, but it's not the first source of funds for companies, for a very simple reason, to be honest, because the majority of companies in Europe are small and medium enterprises. So we're talking about 99%. And so, of course, they don't have access to bond markets. This, to be honest, is a problem, is one of the main problems of Italy, for example, because the problem with small companies is that you cannot push with productivity. And since the GDP is a function of productivity, you have a smaller GDP growth and a lot of problems for that. And why do we have small companies in Italy, Jacopo? I don't know, maybe because of cultural reason, and everyone wants to be the leader.
Family business culture.
That's the point, I guess. So here we go with the bond market. One of the main...
If I can interrupt for just a second, because this is very interesting you mentioned that, because earlier I was talking about the separation of ownership and control. And the idea of, the family business culture is the entrepreneurialism controlled by the original owners. There is as we get more data, that actually seems to be much stronger than what we used to conclude from data from 25 years ago. So we might see a bit of a reversion to that in the US as well.
I don't know about the US, but in Italy it's like very evident. So
we are very unlikely to leave decisions to people we do not trust, or to even people we do trust but are not part of our family.
Yeah,
and that's cultural.
Right. And and that's true of a lot of cultures. I think Wenli and Khushbu can also jump in, and that's true of Chinese and Indian cultures as well. So it's it's almost uniquely an Anglo-Saxon viewpoint about relying upon purely professional credentials.
Yeah.
Any comments, Wenli, Khushbu?
It's I won't say that there is something like this that we can relate to the culture in India. So,
Okay.
Yeah, I don't have any comment on that.
How about you, Wenli?
Yeah, so I feel like the cultural differences are quite minor in China because
Okay.
basically we mimicked what Western culture did, and so that's probably like my opinion.
Okay, well, good. I put up a hypothesis and the data struck it down. So there you go. That's how a good empirical work happens.
That's very funny.
All right, Marco, continue.
Okay, so if I talk about the European bond market, I should mention the fact that we have only one central bank for 19 countries. And of course, you all know that there is an interplay between the monetary policy and the fiscal policy of a country. So of course, if we have just one monetary policy, that may create a little bit of struggle for some countries. And as you can see, we have very different fiscal needs from this chart of debt to GDP of different countries. And the bottom line is that usually the European Central Bank tends to be very accommodative with its policy. And in order to level up a little bit the fiscal needs, the fiscal policies of different countries, in 1997, Stability and Growth Pact was introduced. So a set of laws to regulate the budget deficit, and this kind of stuff. And of course, the German Bund is the risk-free asset. And here you can see the yield curve that you will study about the German Bund that was all negative a few days ago. So a little bit of history is very important. If you are familiar with the US, it's very important to understand that in Europe we had two crises. We had the Great Financial Crisis and then a sovereign debt crisis. Why did we have that? Well, very simply, in 19 countries we have the euro, so just one currency. And as you can see, when the euro was introduced, investors thought that different government bonds have the same risk. And so basically you had the Italian BTP, so Italian bonds, trading at the same price with the same yield as the German ones. So that was clearly a kind of mispricing, if we can say that. And it had many implications. We cannot mention all of them here, but as you can see, the yield spread was almost zero for all countries until the Great Financial Crisis. Then what happened? Well, investors started to price something else in those bonds. You can call it default risk or redenomination risk. It's kind of difficult to define it because by definition, sovereign should not have default risk. However, if you think about it, if you have a government which is issuing bonds in euros, it's like this country is issuing bonds in a foreign currency. That's not true, but if you think about it, why? Because the government cannot print through its central bank money. So it was a kind of redenomination risk, default risk, and you see the yields spreading. And that was a very doom period for Europe. We went out from this mess thanks to the central bank, and in particular to three main policies. Of course, the asset purchasing program, that is the European equivalent for QE, and ultra low interest rates, we will see them, but especially outright monetary transactions which were a policy announced by Mario Draghi in his famous speech in London. And they were it was a policy aimed at closing spreads. So it was a very powerful tool. It has never been implemented. And you can see here the bonds purchased by central bank. And here is another striking difference with the US. That is the level of interest rate. I said that, you know, one response of the central bank was to cut interest rates. So the main point is that we arrived with negative key interest rates. So the interest rates set by the ECB. You can see the three main of them here. And the point that we have entered into this crisis, the COVID crisis, with negative interest rates. So imagine if the Fed had not the possibility to cut the reference interest rate. So, and also it had this fact of very low and even negative interest rates and a huge implication for the banking system. European banks suffered a lot because of net interest income was reduced. In other words, their profitability went down a lot compared with, you know, American big players. So that was also very important. What were the effects of this very expansionary, very lax monetary policy? Well, first of all, the level of debt worldwide increased a lot. Here we have, of course, it was not all because of the European Central Bank, but also because of that. You can see the breakdown in different areas. So emerging economies, advanced economies, and all of them. So again, the second point is a technical one. Okay, the euro started being sold in carry trades, but this is more technical. And then, of course, the amount of negative yielding bonds skyrocketed. So in the summer of 2019, it reached 17 trillion. That was a lot. And then all the other implications, especially for pension funds and asset allocation and risk aversions. Here we can have a look on the primary market, and we are seeing in the data what I was talking about. So if interest rates are very low, it's very convenient for borrowers to issue new debt. So companies started issuing a lot of debt, and you can see the amount of debt issued in Europe. The expectation for 2020 were taken before COVID, so that's not updated. And it should be roughly, apparently, half of 2019, roughly. And then what was the reaction of the central bank to the pandemic? Well, to be honest, the reaction of the European Central Bank was very strong, and they moved very fast. It was one of the most productive institutions in Europe. And they basically started this pandemic emergency purchasing program that was similar to the asset purchasing program. So basically buying what you can guess government bonds, because they wanted to finance governments in this way. And initially was 750 billion, right? Okay.
Yes.
And now, now it is 1.3 trillion. They scale up. And in particular, this amount is not proportional to the contributions of single states to the ECB. So, for example, Italy receives more for free. So, just to state.
And if I can add just one thing, this 1.3 trillion euros to be injected in the economy was a result of struggling negotiations between economy and finance ministers of European countries, because there was a polarization of the negotiation. So the northern states, such as Netherlands, Germany, didn't want to implement this policy because their balance sheet, their government balance sheet were much more healthier than southern states such as Italy, Spain, Greece, just to add this political scenario.
Right. But
Yeah,
Greece was a bit of even of an outlier even among southern European states, right?
Yeah, to be honest, Italy has not done very well in the last 5 years. But there is a lot of debate, and you can imagine all kind of arguments and discussion. So very quickly, the derivatives market. As you can see, it is basically the most developed country, the most developed market in the world. Sorry, the largest market in the world. Of course, with data until 2018, but we had 475 trillion of securities exchanged. And also in this case, we can see that the US are far ahead than Europe for a few reasons. First of all, regulation that is stricter in Europe because, for example, the MiFID II directive. A second reason is that you know, 80%, around 80% of derivatives has to do with interest rates, and so since we have very low and fixed key interest rates, apparently this fact played a role in, you know, the decreasing amount of derivatives out there, and then some very specific different market infrastructures. And again, basically, this is true also for securitization and securitized products. Here the reason is that in the US, government-sponsored enterprises play a very important role, and they're not so popular, so important in Europe, and also again the regulation. And as you can imagine, mortgage-backed securities are the most important category of this kind of derivatives. So that was all for us, and thank you, Rajiv, again for this opportunity. It is always a pleasure, and we're here ready to answer to any question. And you know, if anyone wants to have any advice about Europe or.
Excellent. Well, Marco, Jacopo, thank you very much. One thing that I have, I've told you this before as well. It's, Bocconi is the strongest econometrics program outside of the US and the UK. So it tells you how strongly well-trained Jacopo and Marco are. And the kinds of questions they often send me, particularly about derivatives and so on. And I'm like, wow, that's a detailed and very difficult question. So, so it tells you about, the level of sophistication that the two of them bring to their studies on finance, and which I also saw when you were direct students of mine. And Wenli was actually their TA. So Wenli can actually speak to how good Jacopo and Marco are. So as I have told you before, I have in front of me 4 of the best students I've ever had. I so celebrate your success and so look forward to all your success in the future. So once again, thank you very much.
Thank you, Rajiv.
Thank you, Rajiv.
Thank you so much, Professor.
It's
All
up to
right.
us that we have to thank you. It's not... Thank you very much again for this opportunity, and please incentivize your students to send us questions and improvements for our presentation, because we really enjoy doing this.
Excellent. I will actually do that. That's an excellent idea. I will put that on the discussion boards, and yes, incentivize them to send you their ideas and to keep in touch with all of you. And once again, I have volunteered your time, and I hope you won't mind. And thank you very much once again, all of you. Take care. Enjoy
Whenever you want. It's a pleasure.
Take care,
Excellent.
Professor.
Excellent. Enjoy the rest of this great week, and hopefully, you're all staying safe and healthy. And this too shall pass. The world will recover, and we will look forward to fabulous economic and financial growth in the future. All right.
Absolutely.
Thank you, Rajiv. Bye-bye. Take care.
Bye.
Thank you.
Bye.
Bye.